Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Matthew Bartolini. He's the head of SPDR Americas Research at State Street Global Advisors. We're going to take a look at ETF inflows and outflows to see if it's confirming the reversal in market sentiment. It's great to see you as always, Matt. You know, ending the week, February 28th, on a down note, and really you can get a really good sense of what ETF flows are telling us, and it seems to be that they're confirming the reversal we saw in the market.
Yeah, it's 100% a confirmation. I mean, we look at equities, there are massive outflows, and in fixed income, we've seen inflows. In the areas where we've seen inflows, it's been into the more safe haven areas like aggregate and government bonds. And then if you dive even deeper into the fixed income, high yield ETFs, they've had 4 consecutive days of over $1 billion of outflows. That's the most amount on record in terms of consecutive nature. So definitely a confirmation of the risk off and sort of panic driven environment we are in, where basically you're taking down your risk levels while seeking to ballast your portfolio against any further declines.
Yeah, I mean, it's February 28th, February 19th, there was 7 trading sessions ago that we were at all-time highs, and the speed of this correction is really what I think has thrown people off guard.
Yeah, it definitely has. I mean, we saw a massive amount of inflows into gold as well, because you typically think of that as the ability to mitigate both equity and rate risk, particularly also macro risk shocks. Interesting thing is we saw gold prices move much earlier in the month because it's sort of starting to react to what was going on in China, given that local China demand for gold. And so gold reacted first, and now what we're seeing is the rest of the market really react over the last 6 days, falling more than 10%, that fastest correction we've ever had. And definitely, you know, taking down of that risk level to where when we started the month, people were really exuberant about the path ahead for 2020.
Yeah, so if you like prices at the beginning of the month, you really must love them now. So the question is, what will this look like? Could it potentially be a V-shaped recovery? Could the velocity on the upside mirror that? Because typically in markets like this where they correct, it's a little bit longer than a week and a half.
Yeah, I mean, what's interesting is we saw a very anomalous event where you had 2 consecutive days the S&P 500 fell by 3% or more. That only happened over 36 times back to 1933. So really not a lot of times where we had these sort of violent day-over-day drawdowns. And typically by the third day, you're positive, with basically a 1% return. We haven't had that. So it's a very different environment where it's very sort of fear-driven, panic sell-off with a lot of uncertainty. And the big thing is this uncertainty is around growth, because it's a growth shock. You really don't know what the resolution will be and really how far it extends, because it's really hard to model this. You had the viruses in the early 2000s, a much different global economy right now. So I think what we might see happen is fiscal stimulus measures, definitely China and Malaysia have come in, but what's going to happen in the US and what's going to be monetary policy? It's likely to be more dovish, so the probability of a V-shaped recovery is there. It's just the big question of, is it uppercase V or a lowercase V?
Right, right. And you know, I think even if you look at SARS, which was nearly 20 years ago, so you have 2003 and some of the other cases that you had mentioned, we didn't have exposure to social media and the online applications that we do right now. So I feel as if the fear is really trickling through faster. Plus, we're also talking about potential election results. So you have that in the system as well. It seems like there's a confluence of things happening here.
Yeah, I mean, the rate at which news travels now is extremely fast, and the way in which markets are moving is very idiosyncratic. We've been talking about these micro bursts of volatility because you definitely have sort of a tranquil environment, and then there's a macro risk shock, and then all of a sudden news is priced in rapidly, and you see more violent sell-offs, but sometimes followed by more equally violent rallies. And I think the market's sort of trying to find that bottom level. We've seen definitely really bad technical environment. Only about 7% of S&P 500 stocks are trading above their 50-day moving average. That's the same level we saw on December 24th, 2018, before the market started to rally. So I think we're trying to figure things out as we end this week, but it's really hard to sort of be wrong over the weekend, given just how much uncertainty there is.
Yeah. All right, Matt. Great to see you as always. Thanks for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.